You ever get that feeling that our entire economy is just stuck in a mad dash, always chasing the next 3 months? Well, today we're going to dive into that mystery and explore a really fascinating idea that capitalism's obsession with the short term isn't a flaw. It might actually be built right into the system.
It's a pretty wild paradox when you stop and think about it, right? I mean, you see it everywhere. Quarterly earnings reports, stock tickers flashing every second, this nonstop pressure to deliver results right now. So yeah, why is the whole world running on a 3-month timer?
And here's the kicker. The really big stuff we need to tackle, like climate change or coming up with the next life-changing technology, those things don't happen in a quarter. They take years, sometimes decades of patient work. So what's with this huge disconnect? That's the puzzle we're going to unpack.
Okay, so to really get our heads around this, we have to reframe the problem. According to the source material for this explainer, this isn't just about bad habits or poor planning. It's something much deeper, a structural issue with how capitalism itself keeps time.
Now, you know the usual suspects we blame for this short-term thinking. We love to point the finger at greedy CEOs or bonus structures that are all out of whack, or just say, hey, the market's crazy. But what if those aren't the cause? What if they're just the symptoms?
And this is where it gets really interesting. The core argument here is that the problem isn't broken people. It's a broken system for managing time. The money that fuels everything, the capital, is literally wired to follow the wrong clock.
So how do we make sense of that? Well, the research uses this really powerful metaphor to explain it. Imagine our economy is being run by two totally different competing clocks. So on one hand, you've got the fragility clock. This thing is frantic. It's ticking away in days and months. It's driven by all the noisy external stuff like quarterly earnings calls and market sentiment. It's super volatile. And then you've got the mission clock. This one's the total opposite. It's slow, it's steady, and it ticks in years and decades. This is the clock of real, lasting value. Things like innovation, building new factories, or growing a brand. And this right here, this visualizes the problem perfectly. Just look at that massive gap. Those short, chaotic bars, that's the fragility clock in action. Financial reports, political shifts, all that noise. But the long, steady bars, that's the mission clock, where actual value gets built. The whole system is basically forcing everyone to listen to the fast, frantic clock, and that creates what the source calls temporal market misalignment. So what's the real-world fallout from this? What happens when you've got this massive misalignment? Well, it creates a trap that even the smartest, most well-intentioned leaders and investors can't escape.
And this quote just hits the nail on the head. It's not about a failure of willpower. It's not about finding a better CEO. It is a structural trap. If you're a leader who wants to invest for the next 10 years, you are basically trying to swim upstream against a tidal wave.
And get a load of this chart. This just lays the trap bare. That red line shows the average time a CEO is on the job. It's down to just 4.8 years. Now look at that dotted yellow line. That's the minimum time it takes for one major innovation to pay off, about 6.5 years. Think about that for a second. The person in charge doesn't even have enough time on the job to see one big project through from start to finish. It makes long-term leadership almost impossible.
And hey, it's not just the CEOs. You'd think, okay, what about those big pension funds, the ones investing our retirement money for decades? But nope, they're trapped in the exact same cycle. They get judged every quarter, they're under the microscope with consultants every year. Their mission might be for the next 30 years, but their report card comes out every 3 months.
All right, so we've established the clock is broken, big time. So what do we do about it? Well, the source doesn't just point out the problem, it actually proposes a whole new blueprint to fix it. It's called Regenerative Capital Markets, or RCM for short. And the best way to think about it is like a brand new operating system for time, for our entire economy. This isn't just a tiny tweak. It's a complete redesign with one clear goal. Unplug capital from that fast, noisy fragility clock and plug it into the slow, steady mission clock. So this RCM idea rests on 4 main pillars, and they're all designed to work together. First, you give each company a temporal constitution, basically locking in its long-term goals. Second, you create long-horizon capital pools that are shielded from those quarterly pressures. Third, you change reporting to focus on those big multi-year missions. And finally, you tie executive pay to actually completing them. Okay, so that's the how, but what about the why? What's the big payoff here?
What actually happens when you finally get the clocks in sync? This table really lays out the night and day difference. You go from this frantic quarterly focus to a super long-term view. We're talking 5 to 50 years. Instead of just extracting as much value as you can, what they call alpha extraction, you switch to beta regeneration, actually building and compounding value over time. The whole point of the market changes from just finding a price to actually aligning with a mission. And this graph, wow, it makes the whole thing so clear. That red line, that's our current system. It's a system that basically eats itself over time by pulling value out. But look at that green line. That's the goal. A system that reinvests, grows, and compounds value. It regenerates itself instead of depleting itself.
So if there's one single thing to take away from all this, it's this simple idea. The source material argues we've spent decades trying to fix the wrong thing. We've been fiddling with people's bonuses and blaming their behavior, when the real culprit, the whole time, was the broken clock.
And that leaves us with one big final question, doesn't it? If we really want an economy that can solve our biggest challenges, do we just keep asking people to run faster and faster on a broken treadmill? Or is it finally time to build a better clock?